Welcome, Focus Learners, to this explainer. Today, we are diving straight into a massive tension that's brewing right now in the global economy. On one hand, you've got the comforting, reliable stillness of traditional accounting, and on the other, the relentless, hyperspeed reality of blockchain technology. We are going to break down how these two totally different worlds are colliding, and more importantly, how you can actually navigate this shift. But to really wrap our heads around the size of this transition, we've got to start by challenging the core idea of how we record value in the first place.
Think about this quote for a second. What happens to accounting when the books literally never close? Just let that sink in. For generations, right, the finance profession has been built on this very structured, almost comforting rhythm. You hit the end of the month, you freeze the frame, you reconcile all those pesky discrepancies, and you report the numbers. But the material we're digging into today completely shatters that illusion. It poses this terrifying but kind of thrilling question: what actually happens to your job, to compliance, to your whole financial worldview when that neat little closing process just vanishes entirely? Section 1. The end of the snapshot. Finance evolution.
All right, to understand where we're going, we really have to understand that old expectation of stillness in finance. We've traditionally operated using what's called cyclical batch processing. Closing the books is kind of like taking a static photograph. It's a snapshot to see exactly where a business stands at one specific moment. It's like trying to measure a river by just filling up buckets at the end of the month. You swipe a corporate card, the bank checks its ledger, a clearinghouse verifies it, and then, maybe 2 days later, that classic T+2 settlement, the cash actually moves. It's slow, it's heavily segmented. But Web3 introduces continuous, real-time tracking. These instant transactions are like a constantly flowing river. On the blockchain, you don't build buckets at the end of the month to manually measure the water. No, you build flow meters that track the current in real time, constantly.
Section 2. The Infinite Ledger, Web3, and blockchain.
So the real engine driving all this continuous flow is the smart contract. Now, a smart contract is really just a piece of code. But man, it changes absolutely everything because it executes totally autonomously on the network. It verifies the balance and moves the value instantly. There is no centralized middleman here, no bank holding things up for 2 days while their back-end systems try to talk to each other. The transaction itself and the settlement become the exact same atomic event. It happens at the exact same time. And because value moves and is recorded in real time like this, that historical separation between recording a transaction and reporting it becomes completely obsolete. Which begs the question, does this mean the human finance professional is dead? Does this infinite ledger make your traditional accounting skills useless? Well, let's tackle that head on.
Section 3. Code versus economic substance. Financial meaning.
To really get a feel for this tension, let's look at a concrete example. Imagine your company locks up some crypto assets in a decentralized protocol. In return, that protocol perfectly, cryptographically, deposits exactly 100 new tokens into your corporate wallet every single week. The code executes flawlessly, every time, without fail. The blockchain gives you absolute, immutable proof that those 100 tokens are sitting right there, and it's verified by thousands of computers all over the world. It's this closed, mathematically perfect loop. But here is the catch. Here is what the blockchain absolutely cannot tell you. What is the actual economic substance of those 100 tokens under global accounting standards like IFRS? Is this interest income from a loan? Is it a dividend from some investment? Maybe it's a newly minted intangible asset. Or, hey, perhaps it's simply a return of your original capital. But code has literally no idea. It just knows the math checks out. And that right there highlights a crucial reality for us. Code establishes that a transaction happened. And yes, it's mathematically flawless. But human expertise establishes the actual meaning of that transaction. You see, businesses still live in physical jurisdictions. If a company in Dubai receives a bunch of borderless crypto tokens, the local tax authority doesn't care that it came from some decentralized network. They want to know the legal and tax implications for their specific region. So to accurately map that on-chain flow to local compliance realities, traditional financial expertise isn't just helpful, it is absolutely indispensable. The ledger needs a translator. Section 4. The Web3 Transition Roadmap. Adapting to Web3. Okay, so if you're a professional trying to not just survive, but actively thrive over the next decade, how do you adapt? Well, here is your step-by-step roadmap. Step 1. You've got to unlearn. You have to stop relying on banks, clearinghouses, and third-party auditors as the ultimate unquestionable arbiters of truth. You need to learn to trust cryptographic execution. Step 2. Master the jargon-free basics. Like, you need to intimately understand that a public key acts as an address and a private key acts as the authorization. That's it. And step 3, take your hard-earned knowledge of traditional frameworks, things like IFRS compliance, rigorous internal controls, and actively map them onto this new real-time blockchain architecture. You aren't tossing your skills out the window here. You are just applying them to a brand new canvas. Now, as you map those controls, you really have to understand exactly how the nature of risk itself transforms. In traditional finance, your audit controls are hunting for, say, forged bank statements or some unauthorized humans signing off on a deal. But in Web3, the actual risk is a logic vulnerability in the smart contract code itself. Take a reentrancy attack, for example. This is a scenario where a user basically tricks the software into paying out multiple times before the system can even update its internal balance, and boom, it empties the reserves in milliseconds. So the technological mechanism of the fraud completely changes from human deception to code exploitation. But, and this is a huge caveat to remember, the financial reality of a catastrophic loss of capital remains exactly the same. The stakes haven't changed at all, just the battlefield. Section 5. Redefining professional trust, bridging two worlds. So how do we actually synthesize these two totally opposing financial worlds? Well, building a bridge to Web3 definitely does not mean burning down traditional finance. It means recognizing that both sides have valid, essential foundations. To stay relevant and actually lead in this space, you've got to hold both perspectives in your head at the same time. You have to respect the revolutionary, continuous nature of on-chain tracking while fiercely honoring the strict, unyielding demands of compliance, taxation, and auditing. You're no longer just sitting there manually reconciling past data at the end of the month. No, you are elevating your role. You are becoming a real-time engineer of financial data flows. You're becoming an expert in decentralized trust, and that is a huge upgrade. So I want to leave you with this final provocative thought. We started out today by talking about that traditional photograph, right? That camera flash that freezes the financial frame at the end of every single month. But if the infinite ledger means that camera is now permanently broken and the financial world is instead handing you a live, continuous, never-ending feed, what does it really mean to keep your eyes open? Thank you so much for joining me for this Explainer Focused Learners. I really hope this roadmap helps you navigate the incredible shifts coming up in your own career. Keep learning, stay curious, and I'll catch you next time.